The topic that we're going to be discussing today is whether new entrants can survive an already overheated market, and also the rise of regional lending and its impact on London and the South East.
From a client's perspective, they've never had so many options available to sort of cater for whatever need that they have got. From the brokers, it just means that from the wide variety that's available, then I think it gives us options. It means that you need to do your right level of research. You've got to understand who's in the market doing what to ensure that the advice that you're giving is the best for the client.
From a broker's perspective, I think our jobs have got even harder. Having obviously further options for clients is brilliant. The concern is, you know, how many of these lenders will survive? Are there going to be any impacts on the non-survival of those lenders? So if there are any issues with the solvency of some of these platforms, is that going to have a knock-on effect in the industry?
It's hard to get market share, but as I say, the competition, it keeps people on their toes. We found it's a market that is quite split between people that run lenders, principal lenders anyway, as lifestyle businesses, charge 1% a month, charge huge fees, have got a lump of money from their high net worth mates and just churn it as almost like an alternative to buy to let. And then you've got how we do it, where we're serious about growing. We have institutional funding lines from asset managers and private equity funding. And we have a 5-year growth plan. We're not here for a year. We're not here for a quick hit of that cash. And I think that old market has probably gone now.
One of the areas in which lenders will be competing on it is margin, and actually there's been that's been going down. But essentially, on the other side, LTVs have been going up as well. So and all of that adds to a very sort of risky mix.
Exit is something that when we discuss with a client, you know, we absolutely scrutinise that, and I wouldn't put anyone into a bridging facility that I couldn't clearly define that exit. So whilst margin is going, whilst margin certainly in the south is reducing, rates are reducing, loan to value going up, that's a worry. There are lenders out there now looking at 80% loan to value. I mean, if they go over term and you start compounding interest, how do you exit them? I mean, that's not a good place to be. So I think you've got to temper caution with this explosion that's happening in the market. Definitely.
Guy, what kind of behaviours are you noticing in the market? What do you deem as risky?
It all comes back to how, as a lender, we're going to get our money back. We're not a loan-to-own lender. I don't want anybody's property. Those days are gone. And it's just about dealing with the brokers and relationships, I think it comes to, is making sure that the person you're lending to has the experience, has the track record, and has a viable plan to get out there.
We are seeing a number of rebridges that are around. I don't know whether that's down to the lender or maybe down to the borrower, maybe being a bit optimistic with their plans. Bridging has always been a solution to a problem, and at times clients can be very optimistic with what they plan to do or the timescales to get that done.
There's an element where, you know, you've got developments that are coming to the end that are now maybe 15-20% down on their GDVs, and with the best will in the world, and we can all be brilliant brokers, you know, you can't exit those. You know, so there's a scenario here where I don't think this is brokers' ability. I sometimes don't even think it's clients' expectations, although that can be a problem. We're now in a market where if you've lent 7 million on a GDV of 10 and now it's 8 and the sales still aren't coming to you, there are real problems. And I don't think it's sometimes as simple, you know, sometimes the world changes and you can have the best plans in the world, but you know, things start to go against you, and I think that we may see that happening more and more.
Scaremongering has a massive effect on how surveyors will look at property. You know, we're seeing certainly, you know, 10 to 15% down valuations as standard now. So you have to factor that in when you're arranging that debt product.
One area where I suppose we are particularly struggling at the moment is the gap between kind of a light refurb and a development. There's a lot of products recently launched which will do a light refurb, 15-20% of purchase price, and then there's the bigger development products, kind of 500k plus, but there's a bit of a gap in between the two.
Below market value purchases as well. You know, you've got a couple of lenders out there that'll do 100% of the purchase price as long as you're within that 70% tolerance on open market value.
I think there's still a lack in the, of options in commercial term products. I think there could be an easier way of doing that, and I think also bridging lenders and people that are now looking at offering term facilities could do things to help borrowers exit later down the line.
If a company is happy to take a security on a bridging facility because it requires some form of refurb to make it mortgageable, then why not bridge them out? Don't make them pay another vow. You know, it's for your lending purpose. Don't make them go through another arrangement fee. Don't make them go through another set of legals. You're holding charge anyway. You hold first charge over the property. So it's all about trying to smooth that process. But certainly, I'd like to see more lenders going and doing that bridge to term.
It's really not hard our side, and there's no need to charge another fee as I see it. It's very easy to load fees onto clients, but I don't think it's fair in a lot of cases when we can still commercially run a business by not charging an admin fee, not charging an exit fee, and free legals and vowels we're doing at the moment. So it's not that complicated
Free legals and vowels.
Yeah, up to £5,000 cap. Terms and conditions are available.
There's a mixture of new products, new locations, so we're looking at now softly lending in Scotland, actually Scotland and a bit parts of Wales. And this is all from the back of feedback, and it comes down at the end of the day to the relationship you have with borrowers and your brokers to find out what really is needed in the market. And Guy mentioned, and other people mentioned, productless propositions, right? At the end of the day, you've got a funding line that wants X, and you've got a borrower that wants Y, as long as you can fiddle with the middle part and have the power to. Because some people in their funding lines don't have the ability to change products, to make decisions fast, to make them on the ground. But as long as you've got that mandate or that ability to do so, there's no reason why you can't be bespoke. It's keeping a small company vibe without getting too big, because bridgers normally, in most of the cases, aren't banks, and that is a massive benefit. The moment you become too stringent, you just lose people.
I think if a deal may be going the wrong way, having a direct communication with the underwriter is very useful, and having that underwriter to still have the same reaction times as any normal BDM would be is quite important. The worst thing a broker can do is not know what's going on, because the whole idea is the fact that everyone's got to work together to make that deal happen.
The latest ONS UK House Price Index showed that the English regions with the slowest annual growth were all in the south and east of the country, with the lowest being in London. Following a slowdown in these particular areas, many bridging lenders have bolstered their regional teams. Chris, what do you think are the challenges for bridging lenders to build a regional team and truly understand that local market?
Valuation is obviously an issue the further out of the southeast you go. Northwest, certain areas of Scotland, you can buy properties for well under 75,000. So a lot of lenders have minimum lending targets, minimum figures, where they want minimum 75, minimum 100,000 before they'll even consider a proposition. So the ability to adapt to that moving forward there. We've done a few deals with London-based bridgers where they've used London-based solicitors, and therefore that comes with a London-based price tag. £600–700 more to the borrower than they would have paid if they were using a local firm. So the ability to adapt and to take into account regional variations, I think, will be essential the more people move away from the southeast. I
think it comes down to the broker rather than the lenders being sort of regional. So Manchester has opened up. There's a plethora of bridging lenders in Manchester and of course London. It comes down to the quality of the team behind that. So who's submitting that to that lender? So it's the broker. So boots on the ground, intel on the region that your client is from. Yes, of course it's going to be beneficial.
There's a fine line between achieving economies when it comes to hiring professional folks, so surveyors, valuers, solicitors and so on. And then you can very easily trip into false economies, essentially, which is when, as you were saying, a law firm is appointed which doesn't have the expertise, was used for a small conveyancing job, and now they want to do a development financing.
I think as a lender, you've got to be willing to rely on your third parties in those regions. So take Scotland for an example as a project that I took on to get us to lend up there. We're currently active on 2 deals that we're trying to do. Being from Edinburgh, I know the market. I could call upon contacts, both valuers and legals. We met with about 4 different legal firms. Met with 3 different valuers, all of which are now certainly open to discussions. You've got to be able to rely on that.
Finding resource is also difficult. You know, the further you go away from the London market, staffing becomes an issue. The further you go away from Manchester, you know, it's a very small pool, you know, resource pool, and good quality people are hard to get and expensive. And if you're thinking about diversifying and, you know, going geographically, that's a consideration, that if you can come in and you can buy a shake and bake business that's already operating and has got a profile, that's an easier route.
Reduced transaction levels will have some level of impact on them. The more you've got deals going through, the more of a spread that you can work off. But you will have some quarters where certain regions will see many deals happen for one reason or another, and the rest of the country may have, you know, more or less, and this can impact the data that you're looking at.
I think it's cyclical as well. People, when London had its big hit, or has had its big hit, probably about 20% over the last 4 years, people have moved out to invest in Manchester, Bath, Bristol, other areas to hedge their risk, look at new opportunities. And I think now that those markets have got pretty hot, and maybe they have cooled off slightly. Investors are looking back towards London now a little bit as things start to, touch wood, look a bit more stable around Brexit in the future next year. We've definitely noticed people moving from the home counties coming back in for various reasons, mainly opportunities. They think they can buy cheap, and they've called the bottom of the market, and then they want to push on.
It's the best time to buy if you want to spend £20 million.
Apparently, yeah.
Investors are always looking at an opportunity. And if they can buy something cheap, add value and turn it around quickly, then that will attract them to certain areas. So especially in the regions, as property prices do fall, they will go in and they will buy those properties. So we might be seeing more transactions, and they might be a lower value, but I think that just shows the appetite of good investors moving in there.
Taxation changes on the ownership of residential investment property is going to have a massive effect. And I don't think that makes a difference where you have your portfolio, where you're looking at investing. This is a massive, massive change. And there may be a considerable amount of property that 54% of buy-to-let landlords are looking at offloading their properties, and that's massive.